A credit score can influence the price people are offered for mortgages, auto loans, rentals, deposits, and, in many states, insurance. The difference is not always obvious because it can be built into the monthly payment. Most people think good credit is enough, but excellent credit may place someone in a different pricing tier. Subscribe and turn on notifications for educational finance videos that help you make more informed money decisions. Section 1. Good credit can still be expensive. Imagine Marcus. He's 35, works hard, pays on time, has a couple of cards, and his score is around 713. In his mind, he's doing fine. And honestly, he is. He's not getting rejected. He's getting approved. But approved and best available price are not the same thing. A lender may approve Marcus and still offer a higher cost than someone with an 832 credit score. Same loan type, same city, different credit profile. That is one possible cost difference between credit tiers. Nobody labels it that way. It simply gets built into the payment. And because the payment feels normal, many people never question it. Section 2. Why 832 changes the game. Most base FICO and VantageScore credit scores run from 300 to 850, but the real money difference is often in the tiers. Once a score is above 800, it is commonly considered excellent or exceptional territory. That is where many lenders may view a borrower as lower risk. And lower risk can often lead to better pricing. Do not obsess over a perfect 850. An 832 score is already in a top-tier zone for many real-world lending decisions. Once someone is safely above 800, they may have access to many of the benefits that matter. That is why 832 can be powerful. It does not mean someone is rich. It means the system may price that person differently. Lower rates, stronger offers, better limits, smoother rental applications, and smaller deposits may become more available because the credit file looks clean and predictable. In finance, boring can be valuable. Section 3. The mortgage gap is where it can matter most. Picture two buyers looking at the same $400,000 home. Both put 20% down. Both borrow $320,000. Same house, same roof, same backyard. Using a recent 2026 mortgage rate example, a top-tier borrower may have a principal and interest payment around $1,993 a month. A borrower closer to a 620 score may be closer to $2,179 a month. That is about $185 more every month for the same loan amount, before taxes, insurance, HOA fees, or other housing costs. Over 30 years, that can become roughly $66,700 more paid over the life of the loan. And here's what many people miss. That money also loses the chance to grow. So the credit gap is not only what gets paid, it is also what never gets built. Marcus may still get the house. He may walk out feeling good, but he may not realize he received a more expensive version of approval. Section 4. The car payment does the same thing. Now move from the house to the driveway. Say someone finances a $35,000 new car for 5 years. Recent auto loan data shows super prime borrowers averaging around the mid 4% range, while non-prime borrowers may be closer to the high 9% range. Same car, same dealership, same commute, different credit profile. That difference can add up to nearly $5,000 more over one vehicle loan. And many people buy several cars over time, so this pattern can repeat. This is why I got approved is not enough. A dealership may approve financing and still offer a payment that puts more pressure on the budget. The better question is, what is this loan actually costing? Section 5. Insurance is the quiet factor. Credit does not only matter when borrowing money. In many states, Auto insurers may use credit-based insurance scores as one factor when setting rates. These are not the same as regular credit scores, and state rules vary. Some states limit or restrict how credit-based insurance scores can be used. But in much of the country, credit-related insurance data can still affect what someone pays. Drivers with lower credit-based insurance scores may pay significantly more than similar drivers with stronger insurance scores, even when the driving record is similar. Think about that. Two people may drive safely. Same car type, same commute, same clean record. But one may pay more because the pricing model views credit-related insurance data differently. If this is giving you clarity, tap like so more people can understand how credit pricing can work. Section 6, the 2026 credit shift. There is also an important update for 2026. Mortgage credit scoring is modernizing with newer models, such as VantageScore 4.0 and FICO Score 10T, becoming part of home lending evaluation. In April 2026, federal housing agencies and the government-sponsored mortgage market moved forward with these updated score models. These models may evaluate credit behavior in more modern ways and may help some people with thinner credit files. But the basic rules are not disappearing. Paying on time still matters. Low balances still matter. Length of credit history still matters. Consistency still matters. So the smart move in 2026 is simple. Make a credit profile look reliable, not flashy. Reliable. Section 7, what actually builds an 832 score. The fastest way to understand credit is this. Payment history and amounts owed do most of the heavy lifting. Start there. First, avoid missed payments. Set up auto pay, reminders, and a cash cushion. Do not rely only on memory for something that can affect credit for years. Second, keep utilization low. If a card limit is $10,000 and the statement reports $4,000, that is 40% utilization. A better move may be paying the balance down before the statement closes. Third, stop carrying a balance just to build credit. Interest is not required to show responsible credit use. A person can use the card, let activity report, then pay the statement balance in full. Fourth, protect older accounts when it makes sense. If an old card has no annual fee, keeping it open can help the age of the credit profile. Add a small recurring charge, set autopay, and let time work. Fifth, check credit reports. Look for incorrect late payments, unfamiliar accounts, wrong balances, or outdated negative items. A report error is not a personal failure. It is a data problem. Section 8, the AZEO method without the confusion. Once the basics are handled, some people use AZEO, which means all zero except one. Before statement closing dates, most cards report zero, and one card reports a small balance, such as 1% to 3%. Then it gets paid in full. This is not magic. It is not the first step. It is a polishing move. If someone is missing payments or carrying high balances, AZEO is not the priority. The priority is cleaning up the foundation. Credit habits can improve quickly, but nobody can fake years of clean credit history. That is why an 832 score takes patience. It is not about tricks. It is about consistent behavior over time. Section 9. The trap after excellent credit. Now here is the warning. An 832 credit score may make some financial options cheaper, but it can also make larger offers more tempting. When credit is excellent, companies may offer more. Bigger limits, bigger mortgage approvals, better cards, nicer financing. And that can feel like winning, but approval is not advice. A bank approving a large mortgage does not mean it fits the real household budget. A dealership approving a luxury car does not mean it is the right purchase. A premium card offer does not mean the lifestyle should become premium. A credit score measures how credit has been managed. It does not measure wealth, freedom, emergency savings, investments, or peace of mind. Here is the full message in 5 quick points. Good credit can still be quietly expensive. 832 may create stronger pricing power. Mortgage, auto, and insurance gaps can add up fast. Payment history and utilization do much of the work. Excellent credit is a tool, not wealth itself. I am curious to hear from you. Which credit habit do you think matters most over time? Would excellent credit be used to save more or borrow more? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.